Do you hear me? Yes. Great. Hello, everybody. So before I start my talk, I want to start with a little story. It actually happened sort of on the way here. I have to make a confession, small one. I like when I'm really exhausted, especially on planes traveling. I like to watch really cheesy rom-coms. It just helps me to shut off. So I travel a lot. I go through a lot of them, obviously. But more recently, actually, randomly, as usual on these planes, I click one of the first movies that come up, and it was called Bank of Dave. And it's a British movie about this self-made millionaire that lives in a small town, started out trying to give his customers that were buying delivery vans from him loans, and it started growing and growing, and what he realized was that banks were serving this community very poorly because it was just too small. It was hard to underwrite these loans, but he knew everyone in the community, so he knew who he could give money to without taking any unnecessary risk, and he knew how helpful it is for the community. So long story short, he tries to start a bank, couldn't get the license approved, fought with the British regulators, had to go through all this paperwork, almost got pulled into court. Like a very, and then of course the rom-com comes in, and his lawyer falls in love with his niece, and that's the end of the story. But the thing that really excited me, or the thing that was like, oh yeah, like this is, well, I'm not living out the plot of some weird rom-com. I do definitely identify with the motivation that Dave has, which is trying to actually build financial products that help the people we think we need to help. And that's also my motivation of why I got into crypto, into Ethereum, like 6 years ago. So if you're ever on a plane and you need to turn off your brain for a while, go watch the Bank of Dave. So yeah, I want to talk about real-world assets today and why I think that's going to be the next big summer we'll have in DeFi, and why it delivers on building for real-world impact. So maybe super quick introduction about myself. I worked in Web 2 for about 10 years before going into crypto in 2017. I love to code, I love to build stuff. Started in e-commerce and had kind of like a career throughout various different areas of social media, and then ultimately SaaS, and then fintech. And in fintech, working for a San Francisco startup, we worked with some of the largest companies in the world, Airbus, Toyota, Coca-Cola, and their suppliers. We actually helped Coca-Cola finance their supply chain. And one thing that became very clear to me is, it's kind of obvious, but you don't really think about it when you're just an engineer trying to build software, is that if you have a treasury department with a few hundred people that just make sure you have the best access to money always at the best prices, right? It's much easier to build and run your business than if you're a small business trying to get a $20,000 loan here, a $100,000 loan there, right? So what does this mean actually in exact numbers? Fortune 500 companies, Global 2000 companies, they borrow money at the rate of like risk-free plus 50, 80, maybe at most 100 basis points. That's today 5.5%, 6%. As a small business in the US, you pay between 12 and 20% for your working capital. So think of that difference. Now, if you're building something, and you're not Toyota, you're a startup trying to build something in the automotive industry, you already have like a huge disadvantage just because your cost of capital is so much higher. So this is why we wanted to use the blockchain to make this more efficient, make this better, right? So fast forward now, about 7 years out of my last job and 6 years into crypto, I think we're finally starting to see what this could actually look like. I'm talking here to a group of people. Most of you have probably already heard about the idea of real-world assets, or the fact that there are now assets that exist on-chain that actually represent a claim against some off-chain asset like a car loan or a piece of real estate or a commodity or just equities, right, securities. So basically, real-world assets is just very broadly the idea that we can use all of this tech, these DeFi money Legos that we've built, to leverage them to bring traditional assets on and serve users much more efficiently, using that technology, using the transparent blockchain, the automated smart contracts that we know are kind of trustless and everyone understands how they work, right? And so let's talk about how actually real-world assets work, what I think are some of the opportunities, and where maybe you guys can start building on them. So a bit about Centrifuge. I think I can safely say that we were a bit of a pioneer in this. As you can see, we started, actually the first test transaction we did in 2019. Then 21, we actually minted the first DAI with Maker. It was a 5 million, it was a $5 or $15 million debt ceiling for New Silver. New Silver is a fix and flip mortgage company. So they finance real estate entrepreneurs that are buying rundown houses, renovating them, and then want to sell them. So New Silver in the last couple of years has financed over 100 loans. They've originated, I think, over 300 loans, originated almost $100 million in loans. And from there, it's been kind of like growing very slowly to, at some point, like obviously been growing, started to grow much, much faster. And I think as more and more people understood actually that we can tokenize these assets, we can make them compatible with DeFi, I think we're starting to go back to maybe what for a lot of people that got into crypto in the early days is maybe a more true to what we actually wanted to build, right? We built like Bitcoin white paper, a lot of the ideas around early crypto is not to like create an alternative virtual world, but to fix the problems that people have today. And with real world assets, we're starting to do that. At the same time, like if you look at DeFi today, like we have a bit of a problem because while the Fed funds rate, so risk-free rate or whatever you want to call it, has been going up, like DeFi collateralized lending has gone up a little bit, but not much, right? So effectively what that means, like on-chain opportunities are actually pretty small versus the off-chain opportunities that have been growing quite a bit. And obviously if we actually manage to bring off-chain opportunities into this, then we can kind of level the playing field. At the same time, just about every bank, every consulting company, they started having positions on tokenizations, on how much of assets, traditional assets, come online, right? And this is just one of them. It's actually kind of a middle of the field. Boston Consulting Group estimates it to be about 16 trillion by 2030, right? So just to put that into perspective, we're measuring DeFi TVL still in the billions, so their estimate puts that at several thousand X. Now, of course, in the real world, it's actually quite normal to measure asset classes in the trillions. JP Morgan, I think, has 25 trillion assets under management, right? So if we think of like scaling DeFi, like this is a massive opportunity. On the other side, when I talked about the borrowers getting access to capital, which they obviously all need, but we also have the lenders that want yield. If you're in Europe, you're a high net worth individual, you can go to your investment bank and you can say, okay, I'd like to buy treasuries, I'd like to buy some private credit, some venture capital, some stocks, and maybe all of this other stuff as well. If you are not, then you can be happy that a Robinhood will allow you to buy some stocks, and maybe you can get a Coinbase account to buy some crypto, but a lot of opportunities to actually get yield are closed off to you because you're not in the, not connected to the private credit market. You don't have like access to these products. You can't just say, oh, I'd like to invest $5,000 into a VC fund, for example. So Wall Street really managed to wall off Main Street, so to speak. Like the S1 process, right, of like going public, registering a fund, like it's incredibly laborious, and so for most opportunities, people just don't do it. So that creates like a system where today we have kind of like this insider system, and then we have like retail, and I think that's just wrong. Like in the end, what that results in is there's a bunch of intermediaries that make sure that when someone borrows, as much money gets accrued to Wall Street, and then like retail investors can go in, pension funds, etc. But in the end, a lot of value gets lost, right? At the same time, finance is really eating our world. This is actually a conservative estimate, and it's also already 15 years old, but I couldn't find a more recent graph quickly, but current numbers estimate percentage share of GDP of the financial industry to today be at around between 12 to 20% of global GDP. So if you think about it, when you buy your Starbucks coffee, your $5, 50 cents of that goes to the people that run the financing infrastructure, like credit card terminals, like the investment bank that listed Starbucks stock, the financiers that finance their supply chain, right? So, like, you could say what you want, but I do think it's a bit too much, and it definitely should not continue growing like that. I mean, it was great to go into Wall Street 80 years ago, and I think it's as good of a time to go into DeFi today, because this is a massive opportunity to remove a lot of cruft that has accumulated over the last couple of decades. So, oh, the animation doesn't work. Too bad. Well, you can imagine what will happen. So, how good of a job are we doing, really, at delivering on this vision of actually fixing finance? I could say absolutely terrible, but I could say actually also really good. Aave collateral publicly 24/7 available. You have Maker, which has been now live with the stablecoin for almost 6 years. It went live, I think November, December 2017, and it's gone through massive turbulence in the market. Also, people are starting to understand it. Like, when you used to talk to Wall Street, you would look at they would ask about Bitcoin as a speculative asset class. Today, they're asking questions about how it actually changes how they're working and what they're doing. So we've been chugging along. DeFi is now a couple of years old. How do we get it to really grow? It's still a massive field of opportunities, right? It's users measured in the hundreds of millions and billions. It's assets measured in the trillions. It's waiting for it to be disrupted. It's using infrastructure today that I could talk here for an hour and tell you stories about how funds are trying to look for $50 discrepancies in their balance sheets that come from like a couple $100 million in trades, and they just spend a week looking through different spreadsheets, talking to everybody, and you realize that like this meme of like finance being powered by a bunch of Excel spreadsheets actually is true. And if you accidentally delete a row in the spreadsheet, you're going to spend a lot of time trying to figure out who deleted it, why it got deleted, and how you undo it. So this is how finance does work today, right? And it's definitely not how DeFi works today. So I think, right, like when looking at opportunities of how to fix TradFi with DeFi and real-world assets, like look at the transparency you can get versus FTX or really any other bankruptcy that is a massive mess where no one knows what is where and who owns what, and we've probably spent already at least 100 million, I think, in the bankruptcy of FTX, right? And it's only going to get worse. And this FTX is maybe a particularly messy example, but try to wind down any large like financial institution, the same thing will happen. I can talk about Silicon Valley Bank that like very cleverly hid a huge amount of losses until everyone freaked out and ran. Wouldn't happen in an on-chain money market. 2% credit card processing fees is still normal. And when you think about that, Small retailers, right, like the coffee shop around the corner, they have a profit margin of about 5%. So if you can cut out the 2.5% credit card processing fee, you're not cutting out 2.5%. You're actually increasing their profit by 50%, right? So the scale of some of these things is actually quite massive. Another use case, global settlement of transactions, like remittances cost on average 6.25%. So imagine the poorest people in the world relying on payments from their workers across the US, for example, right? There's hundreds of millions of people sending money back to their families, and they're all paying like 6.25% on average. For what, you gotta wonder for what, and we already know actually, Ethereum today makes this look cheap, right? So the idea that we can just use a stablecoin to settle something 24/7 immediately is quite the shift. So, and of course, we can compete on lending costs. I think this is still kind of like quite staggering. So I'll try to explain this graphic a bit. This is from the International Monetary Fund. They looked at kind of structures of different lenders. So you have non-bank emerging markets, you have banks, emerging markets, non-bank America, Europe, Bank America, Europe, and then DeFi platforms. What you can see is the yellow is kind of the funding cost, right? That's the cost of what your borrowers pay. And that, in theory, in an efficient market, it shouldn't be that different between DeFi and the real world. But then everything to the right of it, right? The labor cost, the operating cost, the margin, that's all stuff that really shouldn't exist. And you can see that like a DeFi money market is already orders of magnitude better in basically providing a very simple lending service over a bank or non-bank lender, right? So this is what we focus on, which is maybe a bit of an overcomplicated slide, but we focus on basically connecting investors and borrowers, which is actually two parts. It's the making sure we can securitize assets, so bringing them on chain, and then figuring out how we can allow them to unlock liquidity pools, right? So it addresses a few of those things. It addresses the fund management administration going from like spreadsheets to having everything on chain and having a ledger that actually allows you to track it, to figuring out how to actually connect this to DeFi protocols like Aave, Maker, etc. So I wanted to highlight a few things that we can do, and I also wanted to highlight maybe some of the learnings. So when I got into crypto, I couldn't care less about finance, and I didn't know a thing about it. Probably I hardly understood what actually was at the root of the financial crisis in 2008, even though I definitely very vividly remember. And so this is maybe one thing that I can say now, probably would have been ashamed of myself 15 years ago to say that, but I would say I'm a finance person, not just a coder anymore. And I realize how important it is. But I also realize that we need to take some of the learnings, because not everything in finance is completely wrong, right? So diversify, so we need to remove correlation in DeFi. Real-world assets can do that. We need to emphasize sound financial policies. Yield does not grow on trees, and everything else is kind of like asking mostly retail users to take unnecessary risks, i.e. Anchor, Luna, yield farming, whatever. And we need to try to solve real problems, because if we solve real problems, we'll get support from the government, from banks, from users, and that's ultimately how we will make this successful, by actually building something that people want and that people can identify with and that can see. So this is kind of my ask, and I think my message to everyone that thinks about DeFi and how we get to the next bull market, which is, in my opinion, really focusing on these real applications for DeFi. So I wanted to invite you to kind of think of this field of opportunities and go think about some of the numbers I mentioned, do some research, read a bit more, talk to people that work in finance and have them explain to you how some of this stuff works. And you'll see a lot of stuff that you can look at and you can fix. And there's a lot of stuff that we're at Centrifuge spending every day on to fix. So I hope I was able to motivate you a bit and share my vision of DeFi. Hope, come join me. Do we have a minute for questions or not? Okay. So we have some opportunities for questions. So if anyone has questions, please feel free to raise your hand.
Thank you. Thanks a lot for your talk. I guess the main question was about like two parts of your presentation, where like one message was that finance is behind the wall of Wall Street, and not just Wall Street, like government banks, they're like dragons sitting on their treasuries. And then on the other hand, your message was to, you know, go out there for real like application, to go to the real world and try to integrate with those systems. So how do we bridge it? Thank you.
We bridge it by bringing those assets into DeFi, right? By taking loans that exist today and tokenizing them, and then figuring out how DeFi protocols can be used, which is what we've been doing, right? We've been now for 2 years working with Maker to bring real-world assets to them, and they now have actually a majority of their collateral is real-world assets. There's legal work behind it, technical work, et cetera, et cetera. So that's where I would start.
Lucas, I'm a big fan. You guys have been building for a long time, right?
Yes.
And recently, we have seen treasury bills pick up quite a bit of volume in Ondo and some of these other things. And Robert Leshner was on Laura's podcast saying that, you know, demand has been the key issue, right? So when you essentially tokenize the property in Texas, no one really wants it in Dubai. There is very little demand for that sort of stuff, or you know, exotic assets, whereas with US dollars or T-bills, I think we've seen an acceleration of demand. These assets are already liquid, and the theory that tokenization will bring liquidity hasn't really quite played out, whereas liquid assets seem to have a lot of on-chain demand. So what does that mean for you know, your future strategy, and what are you building in the coming months or the next year or so that I should be excited about?
So my take on treasuries is that it's an important part of it, but it's not the only asset class. The reason why treasuries today make so much sense is because even in the traditional in TradFi, treasuries make sense because suddenly the yield on treasury is so much higher, but like the other asset classes haven't like caught on. So relative to everything else, treasury yield is just much more interesting. And relative to DeFi yield, right? Treasury yield is actually higher, which is why people are actually interested in it. Otherwise, they wouldn't be. And that was different even a year ago, right? I think with treasuries, the good thing is it's very easy. The bad thing is it's very easy. The yield you can generate is great, but then the technology behind it, I think in the long run, like if a BlackRock comes on chain with a token, there's really no way you can differentiate yourself from a BlackRock ETF in tokenized form if you're trying to build in this, and which is why I think the long-term focus has to be on assets that you can actually provide a benefit to. Like a BlackRock ETF, it doesn't have any additional utility on-chain. Like I can buy it in my Robinhood account. Like the user experience is probably for a long time going to be better. If you look at illiquid assets that you make liquid, you fundamentally change the game, because if you now have these assets and you can trade them, right? That means your whole calculation of this asset class is going to change, because instead of having to hold it until whenever you get the money back, you now know that you can sell it at any time, right? The same way that you can sell treasuries at any time, or large corporate bonds. And so I think that is like what we focus on. Nevertheless, like I mean, in the end, Century Future is pretty agnostic, and we have some interesting stuff also with treasuries that I think we're going to start talking about soon, but I can't go too much into that today.
Yeah, a quick one. A lot has been talked about when it comes to RWA, even since a couple cycles ago, right? Let's just be honest, it's been going really slow, right? When RWA on DeFi, right? What do you think are the key challenges we need to overcome for it to really have exponential growth?
So recently I thought a lot about, well, like I've been doing this for 5 years, 6 years, and I need to make sure I have the energy to do it for another 5 years. I probably will be doing it for another 5 years. It's slow, I agree, and I think one thing in crypto is everyone's very optimistic, and so everyone thinks it's going to go much faster. I think it's actually been going pretty quickly compared to how the speed that finance is moving in general. And there is a lot of complexity, like a lot of real-world impact. It's not just launching a social media app and like getting 100 million users overnight. It is requiring like being very diligent with money, right? Like if you want to get professional investors into this, they're managing other people's money, and if they lose that money, that's the end of their career, right? So they have to be extremely careful, and I think it's slowly changing. I think MakerDAO has the Lindy effect. A lot of the stuff in DeFi doesn't have it yet, where like people are still kind of, okay, I need to see maybe another couple of years until I'm actually willing to jump in. So it'll definitely be a hockey stick, but this is on a time scale of 50 years, right? Not on a time scale of the next 5 years. But yeah, I think this was the last question, unfortunately. But hit me up on Telegram if you have any other questions. Thank you.